Hi, guys. Thanks for tuning in to another episode of Nuggets News, or our monthly housing and economy update with our friend Martin North. It feels like it's been a little while, Martin, but that's probably a result of a crypto bull market and many other things. But what a time to be alive. And today we're going to be talking all about what's going on, but particularly the yield curve control and the bond market, these rising yields and inflation, because central banks have literally changed the recipe or their formula and even what they're sort of targeting, but there's no, I guess, straight answers out there. So it's all a bit of a mystery. Martin and I will try and uh, demystify that for you. But first of all, how have you been, Martin?
Yeah, busy, horribly busy. Like yourself, there's just so much going on. I don't think I've ever been so busy in all the time I've been doing this stuff. And, the backcloth here is uncertainty, right? There's so much uncertainty and there are so many conflicting signals. And frankly, if you go onto YouTube, you can pretty much find every opinion under the sun, from it's all going to be highly inflationary to it's all going to be deflationary to crypto's booming to crypto's going to crash to central banks know what they're doing through to central banks have no idea. So you can pay your money, you can take your choice.
Well, crypto does both all in one day, Martin. So, um,
Exactly.
so where do you sit, Martin? I mean, traditionally, where have you sat on that inflation versus deflation scale, and have you changed your opinion recently?
So I am still slightly more deflationary than inflationary, and I've been in that mode for a number of years. But the reason for that is to look at the evidence from Japan, who's been out longest in terms of quantitative easing, and the ECB, neither of whom has actually been able to generate any inflation of any significant size, despite the fact that Central Bank of Japan owns probably more of the Japanese economy than any other country, and they've been at it for a good number of years. And of course, other central banks are following on. The Fed is following on. The Reserve Bank in Australia is following on. The Bank of England, they're all doing it. The thing to question is whether the quantitative easing strategies that they're actually chasing will actually really lead to real, what I call structural inflation. Now, we've got to be careful here because there will be some inflationary blips simply because we had massive stimulus short term relating to the virus, and then of course that's being withdrawn. So we saw in Australia there was a significant uprise in the costs of childcare, right, which fed into the inflation figure because they basically paid for childcare for a period and then stopped paying for it. Right?
Yep.
Now, that's not the same as wages growth, right? And so for me, the critical indicator of inflation really happening is an acceleration in wages growth. And
Yeah.
in Australia, if you look, since 2011-12, in real terms, wages have gone nowhere. Absolutely
Yeah.
nowhere, right? And it's true also in other countries around the world too, in real terms. So there's no sign yet of any wages inflation. In fact, the Reserve Bank has basically said, don't expect any wage growth until unemployment drops probably below 4%. And that's going to take years. So therefore, they're saying, well, we'll have to keep the rates really low and we'll go on doing quantitative easing for as long as we need to support the economy. So that's the sort of official view, right? Now, of course, there are people out there saying, well, hang on a moment, oil prices have gone up to 70 US and we are seeing the costs of food rising, etc., etc. And so that then takes us into, so what are you measuring in terms of inflation? And you and I have discussed previously that the official measure of inflation isn't necessarily reflective of reality on the ground in terms of people's experience. And I have this theory that if you'd applied the old calculation basis for inflation in the US in 2005, they would not have had to have taken rates so low, they would not have created the global financial crisis, and they wouldn't have created the current crisis. So in a way,
Yes.
what are we measuring in the first place?
Yeah, it's all just part of the smoke and mirrors approach that they take these days. And as you say, it's that word transitory. Powell and all these other central bankers just keep saying, well, it's just transitory little spots of inflation. But what they're kind of welcoming now is, as you just said in Australia, even with the wages, they're saying, well, if wages are going to be flat and here we are on one hand, we've got, house prices are going to go up 30%. They're almost welcoming like negative real returns and telling people that you're going to be falling further behind, but we're almost happy to do that because it's what it takes to get the economy going. So,
Well,
um,
Lowe keeps saying if you want returns, you've got to take risk, right? So what they're trying to do is to get those savings out of people's deposit accounts, and of course the savings ratio went up because people weren't spending and they got all this handout from the government.
yeah,
But what Lowe wants and what the Fed wants is people to actually invest in the markets. In other words, do more of the same, right? And it's just worth reflecting on this, right? The total debt outstanding around the world is about 281 trillion at the moment. 28 trillion of additional stimulus has been created in the last 12 months or so, right? That's a huge proportion, right? We've never been that high. And so the real question is this another leading indicator of, if you like, cracks appearing in the overall superstructure and substructure of the international economic structure that we have around the world, or is it just temporary? Now, you could argue Fed's been at it since the global financial crisis, and of course significantly over the last year, and they have to continue to do this for another 2 to 3 to 4 years. Well, 100 billion, every time they do it, and they're going to do it a lot more times. This is going to put ever more pressure on. But I think what I come back to is real people in the real economy versus all of what's going on in the financial system and bankers and the sort of the duality that's being created. No wonder people are wanting to get more control by going into the crypto world.
yeah. As you say, like they've just decided that savers are going to be punished, or there's no way to save, as well as you have to speculate to get in front in life, and that's where people are looking for alternatives, as Martin's just said. But I guess my views on inflation have been recently that it all changes once you can go directly to the person. So QE, everything we've just described and everything they've done, and in Japan for 30 years, in other markets for the past 10 years or so, hasn't led to inflation because it doesn't get into the real system. Now that they're starting to do stimmies, or if we do these central bank digital currencies or digital yuans, whatever it is, if you're putting money directly into the hands of people, or governments want to start doing massive spending, whether it's going into debt or they're going to have it all monetized directly, and we do modern monetary theory, any of that sort of thing hasn't really been done before. So if you're doing that, and then the money isn't going to the banks or reserves or even into financial markets like it used to, it can go directly into food, housing, commodities, all those things. And I think that's just not even debatable, that we would put up the costs. Inflation would happen if that takes place. So I guess it's a question of, are they going to do that? Do they have the technical means to even do that? And for me, they're walking that line without even realizing it. I think they're taking the same approach and saying, well, instead of doing 10 trillion of that style, let's do 10 trillion of this style. And they're not realizing that this could cause massive inflation very quickly. And then it's hard for them to put it back in the box.
Right. Well, I've got this theory also that banks and analysts are quite keen to talk up inflation, right? And there's a reason for that. And the reason is to do with what's going on in the bond markets.
Which we better dive into, Martin.
Okay. Yeah, well, why don't we do that? Because it really, the bond market in a way, for me, is the leading indicator of what's really going on, right? And so if you look at what's happened in Australia, the Reserve Bank basically set a 3-year bond rate target. And then they struggled over the last few weeks to keep to that target. And so they changed the rules, right? So last week, they forbid the Treasury to effectively lend on their treasuries so that people couldn't short the market anymore, right? And what that did was then pull the target rate back down to where they wanted it. In fact, there's a couple of charts there you might want to show with the 3-year rate. So what
Martin's saying here is, on about March 9th, so basically, well, yields and bond prices are inverted, which we've covered many times.
Yep.
So they're banning people from shorting the market. Is that what you're saying, Martin? To bring those yields back
so people were shorting the market, right? Which basically then lifted the bond rate, right? As you say, price and yield inverted. But basically, the Reserve Bank has now stopped. Shorting in Australia became really much more expensive last week. So they've basically taken that card off the table. So many people now are actually, following on. Although interestingly, there's still upward pressure on even the 3-year. The 10-year in Australia, which is the other chart, actually is significantly up, and it's been consistently up. Right now, the reason for that is partly what's going on locally, but fundamentally what's going on in the US, right? And in the US, we have exactly the same issue. The 10-year US is up really very high now compared with where it was. But there is something which people haven't actually understood. At the end of March, the Fed is changing the liquidity requirements for the banks, which means they will need more bonds, right? 2% more bonds than they currently need, right?
This is the temporary, don't worry too much about your reserve ratios.
Correct, exactly. So they knocked it down to say, look, we want you to lend, just lend. We'll give you, so they knocked it down in the crisis, right? And so banks were encouraged to lend a lot more, although they didn't really in the US, right? They tended to go in and do other things, right? But that liquidity ratio is going to revert at the end of March. Right, now, the theory I've got, and a few other people, not many, but a few others, is actually the banks are, knowing they're going to need to buy more bonds, are actually trying to get the price of bonds down. And the way to do that is to talk inflation up, right? So the point there is, if that is true, and we'll know, in a few weeks' time, this is not inflationary. This is actually another sign of deflation. So we'll see.
Okay, so what Martin's saying is that these big banks, they need tier 1 capital. They need like US bonds at a certain fraction or ratio in their reserves, and the Fed can almost use these big banks as their lever to get the banks to do the heavy lifting for them, to do the QE for them, almost to buy all these bonds. So
and just come in on that. The key point there is the Fed needs the banks to buy bonds. The banks need to buy bonds because basically their ratios require it if they're going to lend more, right? And given the fact that, of course, the Fed is, doing quantitative easing, so they're actually flowing more into the system, they need the banks to buy more bonds. So there is a closed system here that people haven't understood, right? And therefore, this is not a normal inflationary environment, and the bond yields and rates aren't necessarily signaling what most people think they are.
So what Martin just said there is, if the central banks want to do QE, well, what QE is buying bonds off the big banks. And so they need those banks to... this is the problem they had in Japan. Correct. There literally wasn't enough bonds to even buy. And they started buying ETFs and everything they could to just try and prevent things from looking like they were caving in on themselves in deflation. This is the central bank's big fear. So hopefully all that makes sense. And Martin, we've had some juicy conversations already. We're on slide 1.
Well, you always know we have a juicy conversation. Who needs slides?
I know. Should we go to the next slide?
Yeah, why don't we?
I'm liking this background, Martin. There's a bit of a fresh.
I did it a few months ago. Blue shirt, blue background. Bit of refresh there. So
very
walk
cool.
the world.
So this is the unemployment rate seasonally adjusted. We can see it's come back down a lot, but that last little percent or so, central banks are targeting even lower. They're saying that this is going to take years.
So what's interesting is the employment rate yesterday came out at 5.8%, right, unemployment rate, which was much lower than everybody expected. It's 10 months sooner than what the Reserve Bank predicted very recently, and even worse if you go back what the Treasury said. So something's going on with the employment rate, and 90,000 jobs were created. Most of them were full-time jobs. Most of them were actually for women. New South Wales and Victoria was where a lot of the action was, and a bit in Tasmania too, right? So it all looks pretty good, but then you've got to ask, well, hang on a moment, what types of jobs are they? Right? And the other chart there is underemployment. Now, underemployment means people are working, but they're not actually working for as many hours as they want to, right? And it's the underemployment which is the critical point, because underemployment essentially says that whilst people might actually be officially defined as employed because they're working more than an hour a week, right? in reality, they're not necessarily fully employed. And Roy Morgan's alternative unemployment rate is 13%. Right? So it's going to be very interesting to really understand what the true situation is. What we do know is that youth unemployment dropped back a little as well, and women were actually advantaged relative to men as well. So there is some good news in the numbers, but it's not uniformly good. And the question now, of course, becomes what happens when JobKeeper ends at the end of March, right? Because we know that there is about 1 million people who are on JobKeeper still, down from 3.5 million, so that's a significant improvement. But there's a lot of people. Right? What's going to happen when JobKeeper disappears at the end of March? Now, most people are saying that will actually create a rise in unemployment. The question is, how much of it? At the conservative end, people are saying, well, it might be 100,000. Other people I've read suggests it could be 350 to 400,000. Nobody quite knows, right? But this is not uniform across the country, right? And if you go to the next slide, I've just shown you the distribution of JobKeeper for Melbourne, right?
Yeah.
So the reason I've done it down to a postcode level is to highlight this is not uniformly spread across the country or indeed in Melbourne. But there are pockets. If you look at the west of Melbourne, Point Cook and Werribee around there, or if you go over to Dandenong, there are very high proportions of people there who are on JobKeeper. Now, the question is, what proportion of those people will then start showing up in the unemployment numbers? Right? And there's another interesting correlation, and that is, if you recall my mortgage stress mapping, which I've shown you here previously, right? There's a very strong cross-representation between the people on JobKeeper and high mortgage stress. So it could well be that we see an uptick in unemployment over the next few months, which is going to make it harder for the Reserve Bank to reach now its 4-point something target, because they're saying, well, we need unemployment way down to get wages growth to come through, which is why we need low interest rates, right? So that's the first point. But the second is the consequential impact on real people across Australia is going to be very significant. And I'll give you another example. In Tasmania, Launceston is another hot spot. There are a lot of JobKeeper people in Launceston at the moment. Now the question is, what proportion of those will get work, or what proportion will appear on the unemployment numbers? So whilst 5.8 superficially looks quite good, watch this space.
Yeah, exactly. It's the tourism and those regions that are dependent on the things that just aren't flowing like normal still.
Well, but of course, the government then introduced this airline support process, right? Basically, all these half-price flights, which will help the airlines, and it may help the few locations that they've selected, a bit pork barrelish in my mind. But yeah, it's not going to be sufficient to support all of those people who are moving from JobKeeper. I look at places like Cairns, who have very high representation in JobKeeper, so they might get a bit of benefit because that's one of the areas where people have been encouraged to go. But there are also other areas where they're not. And I don't know what you think about Tasmania, but Hobart's on the list and Launceston isn't,
For the mortgage stress or for the
airline tickets.
Oh, airline tickets. Okay. Yeah, no, I think you're going to have the great border divide there as always. So
the point is, there are limited things that the government is planning to do. And they're talking about, for example, offering loans to small businesses to enable them to keep trading. But all my research says that the very small businesses who effectively are struggling will not be able to and do not want to commit further to more loans. They're more likely to turn around and say, time to close. So I think we've got to watch for the unemployment rate to go up and potentially for the small business defaults and closures to rise. Remember that, of course, over the last year, those numbers were very, very low because basically people were allowed to trade insolvent. Well, that's all now changed. So I think my message is we're not out of this yet. This has still got some way to go. And, of course, it's predicated on the vaccine getting rolled out and the virus continuing to be under control and the borders ultimately opening.
Yeah. Only government could see that the north of Tasmania has the higher rate of people on JobKeeper and then not do the subsidy there. So that's government.
And it is, I just want to underscore again, it's really important that people look at the detail where the JobKeeper lives, right? The postcode level analysis is the only way to really understand what's going on because there are some horrible hotspots around the place.
Yeah. Okay. Property prices, record in some places here for the December quarter last year. What do you think about all this, Martin? It's kind of what we've always predicted. And some people were saying in the comments, "Oh, Nugget, you're always doom and gloom on property," but not really, guys. I've always said that if we follow the track of everywhere else, if we go to 0% interest rates and print money, stocks are going to go up, property's going to go up. It's going to be a bubble, just like everywhere else.
Yes, and the fact of the matter is that the data from Domain and from CoreLogic and now from the ABS, who basically relies on CoreLogic data, shows that there was a significant spike in the fourth quarter, pretty much across the country, the major centres and regional centres. Now, got to be careful because those aggregate numbers don't tell you the full story. What we do know is that most of the growth was actually in houses rather than apartments, and that in some areas, in regional areas, the growth was a lot stronger than, for example, closer into the CBDs of Sydney and Melbourne, right? So you've got to be careful with decoding what this information means. I still know of a lot of units and apartments where prices are down 20 to 25% from where they were in 2017. And even in Perth, where there was a price rise, most house prices and unit prices are still lower compared with where they were in 2013. So we just need to put all of this in context, right? And then we need to understand that there is a whole bunch of reasons, low interest rates, government incentives, the home builder package, the home and land support, all the state stimulus as well, as to why people are piling in. A lot of first-time buyers, of course, the first-time buyer rate was very high. But what's worrying about that is that the debt levels are rising. A lot of first-time buyers are highly geared up. And interestingly, I did some work which will come out, in fact, tomorrow in the AFR relating to the Bank of Mum and Dad. And the Bank of Mum and Dad has really shot up again. So a lot of first-time buyers are getting money from parents to buy into the property market. So the question is, how sustainable are these rises? And will they go on? Remember, of course, the Reserve Bank's modelling a few years ago said that it's likely that if rates drop 100 basis points, then essentially that means that over 3 years prices go up 30%. It could well be that we see something similar to that. Who knows? But the fact of the matter is, there are debt issues that we've got to consider as well as just pricing issues. And so this is not necessarily good. And by the way, it also means that affordability has gone through the floor. So affordability is a lot worse than it was as well for many people. So this is not universally good news.
No, that's the big headache, and just again the RBA just talking out both sides of their mouth when they're saying things like house prices aren't, I'm not sure what the word is. They've said they're not in a bubble, but they've also said that they're not even like elevated or unaffordable. It's kind of like how on earth, like what? How are you going to describe them while you're telling people there's no wage growth for over 10 years and their wages aren't going to go up, but housing is going to go up 30%, but it's a good thing. And
Well, and just remember this, the house price index and housing costs don't directly go into the CPI, right? A rental proxy is used, and rents haven't gone up. In fact, rents are still falling in a number of areas. So what that says that the CPI is not representing reality when it comes to what's really going on. Right? That's the first point. The other one is that if you look at the wealth effect, so the next slide, the overall value of property has gone up considerably. And I think the average is around 750,000 across Australia. But that's not uniformly spread. So the point is, it's changing in different locations. In regional areas, prices in houses have gone up a lot. In areas closer to the city, less so. In the high growth corridors, hardly anything. So this is a patchwork quilt again. And so unfortunately, people just get carried away with these high level numbers. But I think you're right. The Reserve Bank is actually caught between, we want people to spend, we want people to feel wealthy, so we want prices to go up, but we also now are talking about risks. And Lowe said the other day, the Council of Financial Regulators will be considering the risks on the housing market. Now, the Council of Financial Regulators is Lowe's other brain, right? Because he's the chair of the Council of Financial Regulators as well, right? Which includes APRA and ASIC and a couple of other hangers-on, right? So we've got this really weird duality where on one hand, the Reserve Bank is thinking X over here, and over there they're thinking Y.
Yeah, and that rolls into this next slide about the transfers higher in regional areas of the property and the turnover. And we've already heard even some states propose different things to what's the tax called, Martin, that they want to
Stamp duty.
bring up? Oh, they want to
Uh,
replace stamp duty
yes.
with this new tax, like an annual
Correct.
housing
So
tax.
yeah, so in New South Wales now people can choose whether to pay stamp duty one off or whether you actually pay each year, right? And other states, and WA is arguing about it, and other states as well. But interesting, just on those transfers, statistically speaking, the transfer levels were slightly higher in 2020 relative to 2019, but not dramatically. But what's
Yeah,
also interesting is the relativity between the capital cities and the rest of state, right? So we know there's a lot of transactions going on out from the major centres because people were moving out. People wanted to get away from the the virus, and with the virtuality that's now around, people kind of do what they want to do in regional areas. And I'm in a regional area and love it and wouldn't never want to go back into the CBDs. So it's really quite interesting just watching the switcheroo. And of course, the interesting question is, will this continue, or will people then turn back and say, oh no, I need to be bigger, I need to be closer to those bigger centres again now? Not sure.
yeah. No, I'm definitely quite happy as well in the regional area. And yeah, with those tax, it's a little bit like, oh, we're not making as much as we used to, so we've changed the rules. Heads we win, tails you lose, sort of things.
Yeah, and you've got to ask the question: if you do switch from stamp duty to a continuous tax, how do you fill the void? Now, New South Wales has tried to sort of keep both ends of the option open, right, by saying, well, you can choose, right? Over time, they hope that more people will transition to ongoing payments over the years. But of course, the other thing to bear in mind is at least you know what the stamp duty is if you pay it all up front. You've no idea what the forward-looking take will be, because I'm sure they'll put the rate up later, right? So basically what you're doing is you're opening yourself to an ongoing exposure relating to the duty that you pay on your property.
Yeah, a little bit like car registration. It just creeps up.
Yeah,
It's
and
not in line with CPI either, is it? It's at their discretion.
toll bridge charges also
Yeah,
springs to mind.
yeah. High risk lending, and we've seen this tick over. This is another just a result of all the things that they're doing to try and say, hey, first home owners, here's your 50 grand, blah, 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 or 95% down, don't worry about it. And all of a sudden, these things are starting to show up in the statistics.
Absolutely. And interestingly, the APRA data came out again to December and showed that loan to value ratios are rising. So there's more high risk lending. Debt to income ratios are rising. And so what that means is that the banks are actually lending more riskier than previously. Now, everyone's saying, oh, it's only a sort of a little uptick. But look, trajectorily, that's very concerning. Also, interest-only loans are up, right? So all of the high risk indicators, which APRA and the Reserve Bank were trying to control 2 years ago in and around the Royal Commission, are suddenly going the wrong way again, right? Now, that is something which to me says at some point the Council of Financial Regulators, loads other brain, will have to do something about this. They won't do it immediately because they want credit growth. And overall credit growth is still quite low. It was up a little bit, but people have been paying down their mortgages as well because they had free cash. So the net growth is still quite low. But nevertheless, this is a leading indicator in my mind of more pressure ahead. And frankly, there are a lot of people I've been speaking to who've got loans that are 8 times their income, 8 times. That is horribly high, and there's no wriggle room if, for any reason, the incomes get compressed.
Exactly. Yeah, that the trend was between 3 and 5, like income housing ratio. In other countries, it's still in that sort of band.
When
And
I
in
when I was
Sydney and
a
Melbourne, got to
Yeah,
10.
when I was a lender in a bank years and years ago, it was 3.5 to 4 times was reasonable, right? And then it went up 5, 6, 7, 8, and 8 times is there now. And the trouble is that people will say, well, I can probably afford it today, but hopefully in a few years' time, my income is going to grow, and that will make it easier. Now, in the early 2000s, when those ratios started to move high, people's income growth was actually quite strong. But since 2011-12, as I said earlier, there's been no real income growth. And there's very little prospect of income growth ahead. So you've got to be thinking your ability to service those mortgages will require, a lot of income for a long time. And the other point, interest rates are really, really low, right? And they'll probably stay low for a time. But if those bond rates were signalling rates going higher, some people are suggesting that maybe mortgage rates will have to go higher sooner than many people think. So I always say to people, if you're thinking about doing a calculation based on your current situation, don't just use the current available mortgage rate, but ask yourself the question: what happens if rates go up a couple of percent? Because the chances are, over the next 5 years, rates will be higher than they are today.
Yes, exactly. All right. Mortgage stress higher again in Feb.
Yeah, and this was a surprise. So it went back in January, and I was thinking, well, here you go. So people are coming back into work, and things are looking right. But it jumped up in February,
Yes.
and that's partly because of the JobKeeper changes and more people going back to work. Partly because the cost of living are rising. Partly because they got bigger mortgages, and partly because some people refinanced and actually pulled down a bigger mortgage, which then had trouble even servicing immediately. So unfortunately, if you believe that the cliff is still there at the end of March, and we've talked about JobKeeper, but we should also talk about the end of the principal and interest repayment holidays. We should talk about some of the other things which are also coming to an end too. So it looks to me as though we're going to see an uptick probably in stress for the next few months. Remember, stress is cash flow. So this is about measuring how people are faring with money in, money out. And it comes back to my fundamental view that there's 1.5 million people who are just about clinging on with regard to their mortgage at the moment, but it doesn't take much to see that that could change. And whilst there are many people saying, well, I don't see what the problem is because everything's fine, I've never been out of work, and my income's still bouncing along, and I'm doing well on the stock market. So there is a section of the economy doing really well, top end of the K, but there's also another leg of the K where people are still really feeling it. 1.5 million in mortgage stress. And interestingly, other research has also shown about a third of the population very much financially strapped at the moment. And then if you add in also some of the older people who still have mortgages but are not getting much income from the income on deposits because the interest rates are so low, you can understand that why some of them may be having issues. So there are still below the waterline significant stress fractures in people's household budgets, and that's concerning.
Yeah, as Martin said, particularly because it's still, it's not March, it's not until the next month's data where we're actually removing a lot of these measures, that like the COVID emergency measures. And so if we're already seeing an uptick when we're just about to change those rules and the repayment holidays, blah, 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 who knows what that spike's going to look like next month.
Yeah. And that sort of just takes us to the last slide, which says, look, I still run my different scenarios. I am becoming more and more of the view that over the next 2 or 3 year, house prices will continue to rise because the Reserve Bank will continue to do QE. They've pretty much said as much. More bond purchases. They could well target the next duration of bond out at the 3 year level. Some people were suggesting they might even go up further down the yield curve using yield curve controls. Doesn't look as though they're going there yet, but they might ultimately. So I'm thinking we're going to see rates really, really low, mortgage rates low, but there is still an alternative counter view that says, well, what happens if the virus doesn't go away? What happens if we actually start seeing more cases, and particularly some of those more virulent strains come into Australia, particularly if we open the borders? What happens if the vaccines aren't quite as effective as people hope? So there are some counter views too. And the bigger question is, what happens if the QE programs around the world don't actually lead to the outcomes that we expect? And in the process, we actually create, if you like, financial system disruption. And if we get financial system disruption, that could actually have significant negative impacts. So my scenarios are more bullish than they were, but I'm still conscious that there are alternative scenarios there. And in those alternative scenarios, home prices would not continue to rise. They would actually perhaps go backwards.
Yeah. I might just finish off with my little rant about like yield curve control. And so we've spoken about QE, which is basically the central banks printing money out of thin air to buy bonds off banks. And the theory is that, hey, buy those assets off banks, top up their reserves, they'll lend more. But it just doesn't happen. It's such a back to front system. And you think about, well, now yield curve control, they're saying, well, we're going to target this section of the yield curves that keep interest rates low at the 3 year mark, as well as our target rate where we set interest rates, and then the longer end of the curve is more to do with the market and whatnot. But if you think about how the other day they had to do $4 billion in Australia, that's an enormous number
Yep.
in one day just to get this number on a screen lower. And that number on a screen, again, it's not doing anything. It's just the smoke and mirrors to make the data look better. And if you think about, well, imagine if we had this problem where they spent $4 billion and we had too much, science research, or too many hospitals and they weren't overstaffed. Like, that's billions of dollars that could be spent on anything, even if it's just giving it to people to go out and encouraging them to spend locally or go on a holiday or whatever it is. I can just think of 100 ways to get the economy going better, or to help the majority of people that is not printing money out of thin air to buy government bonds, which again are just a out of thin air sort of contraption, and it's all just going through the banking system to give the banks more money and to lend, but to lend to who? The only people borrowing are the speculators or the banks themselves. They can't speculate with that money directly, but they can rob Peter to pay Paul. So these days, because the banks are just in the business of lending to people residential, they can say, "Oh, we've got this extra money now. Well, now we can speculate more in that other section of the bank, and we can go out and buy more Apple stock, like we see some of these even central banks doing these days." So it is just the biggest level of craziness for anyone. This is why they don't teach it in school, I think, Martin, because anyone that understands this stuff would be out on the street protesting, saying, "I demand that all money printing, an equal amount goes to the people as goes to the banks," or something like that. It's just so lopsided; it makes no sense whatsoever.
Well, I absolutely support that view, and you and I both believe that that money could have been so much better invested in the real economy in Australia to lay a foundation for a better society ahead, and actually it's one where there is more value being created for real ordinary Australians. Unfortunately, what's been going on is the Financial System Preservation Society, right, where effectively the money is going into the system to support the system, right? And everyone's worried about financial stability and all those things. And to give you another angle on that, responsible lending legislation was due to be withdrawn at the end of March, right? Actually, it didn't go through the Senate because the Senate's now started asking harder questions about why would you would want to remove consumer protections. But it's a really archetypal debate about what's really important. Is really important financial stability of the financial system, which is what APRA is responsible for and what they're now saying is really important? Or is it down to what real people and real consumers are doing and making sure that consumers have the right protections but also the right opportunities, right? And that is, for me, the linchpin of the debate we should be having, because the policies that are being rolled out through the Reserve Bank, and I would also argue through the government too, are not benefiting the bulk of Australians. And until we can actually get that message out and get people to understand that there has to be an alternative approach if we're to actually lay the foundation for you, we're going to go round the same houses as Japan has done, the Eurozone has done, the Fed has done. And the worry is you end up with a bigger burden of debt, more quantitative easing, but not a better real economy. And that's what we need.
Yes. And all this money that's floating around, it's like musical chairs. If people are starting to decide to run for the real things, and whether it's Russia and China and those people that don't like the system, they haven't liked the US-based system for many years, and you see them stockpiling gold, but now they're stockpiling, oil, commodities, lumber, all this other stuff like rare earth minerals. And so it's the same everywhere. But if that happens on the retail consumer level in the everyday economy, where people start running for real things, that's when you get hyperinflation. So hopefully all these moving parts people are really starting to understand now, Martin, with everything we've discussed. And it's why you've seen gold, Bitcoin, even some people are arguing that like shares and stocks to some degree are more scarce than all this funny money that's just been printed into oblivion. So money's going to continue to just flow into everywhere and everything at the moment.
Well, the trouble is that there are risks pretty much wherever you look, even in the stocks, even in gold, wherever you look, right? There are risks. There's no such thing as a free lunch, right? But what I would say is, Alex, that people want more control of their own destiny, right? And I come back to that. That's why I think the crypto thing's quite interesting, because there is a narrative that says you've got control, which you
Be
haven't
your own
got.
bank.
Exactly right, which you haven't got anywhere else. And that's one of the reasons why, if you look at like Ethereum and those sorts of things, and the whole financial plays, and the individual financial models that are beginning to exist, that for me is really interesting because it signals potentially an alternative future.
Yeah, we should probably do an episode about that on DFA, Martin, all the financial sort of
Yeah,
protocols that out there. But
you're on.
yeah,
We'll
that's
do
been an
that.
awesome episode, a fairly long one, but no, still under an hour, but nice and juicy for you guys. I hope you've enjoyed that. Thanks for joining us, Martin, and we'll definitely have to do it again next month.
Look forward to it.
Cool. Thanks, guys.